Hi, my name is Haley. Today I will be going over the finance simulation capital budgeting. So right now we're in 2014. The company got an APV of 4.4.77, which isn't awful. Split up by divisions, the licensing half is what was most profitable by the business, as opposed to the production and the retail having the least profitability. You can see that our revenue from 2009 has increased from 245.75 I believe million to 302.34 million. The operational income has also increased from 22.6 to 34.95, and the net income has increased from 13.56 to 20.97. So that's pretty decent, a pretty decent increase. So now I'm going to talk about the income sheet, balance sheet. So we have the production tab, the retail tab, and the licensing. You can individually click on those and look particularly at the numbers. But we're just going to go over the company consolidated. So for the entire thing. So this is our income statement. Let's see. So currently in 2014 we have 302.34 million in net sales. And in 2024 it's projected that we are going to have 442.04 million in net sales. So going up quite a bit. From 2014 to 2024, we're supposed to just increase steadily. The cost of goods sold also is going up, which makes sense because if you're making more money by selling more inventory, then you're going to be spending more to replenish that inventory. So from 2014 to 2024, we have a steady increase in cost of goods sold. Our gross profit is also expected to increase steadily to 2024 by about 100 million. So that's really good. Let's see. Our earnings before taxes in 2014 was 34.95. In 2015, 38.41. So a pretty good leap there. In 2016, it dropped a little bit to 37.52, but then from there just steadily increased to 58.16 million. And net income 20.97. We increased in 2015 to 23.05. Had a little decrease back to 22.51 million, and then steadily increased till 2024. And these are all predictions. The balance sheet, we have our net current assets. So currently we have $122.39 million in assets. In 2024, we're projected to have $181.73 million in assets, and that just steadily increased all years. we have our total net assets, which is $205.47 million, steadily increasing, not in very big increments, but a good increase till 2024, which would be $321.51 million. Okay, so our liabilities, our total current liabilities in 2014, we have 52.1 million, and so we're increasing all the way till we get to 2024 with $81.58 million in liabilities, which again makes sense if you are selling more, that you're going to be spending more as well. So our liabilities and stockholders' equity equaled out as the total net assets, which is supposed to happen, so that is good. We'll go to our cash flow statement. So our cash flow statement here, we have our total, and then we have it broken up into cash flow from operations, cash flow from investments, and cash flow from financing. So in a business, cash flow from operations is the most important. It should be bigger than your investments and your financing, and usually together. And so what we see here is, let's go back up. So again, we have our total number, which is $34.32 million for our cash flow statement, which is just our net income plus our depreciation. And like I said, that is increasing all the way to 2024. So here we have our cash flow from operations, which ended up being $30.64 million. Steady increase all the way to 2024 with $50.38 million. Then we get to investments, and we see that investments is a negative number, which just means that you're investing money in other projects, so you're putting money out to essentially gain more profit, so that's good. So in 2014, we had negative 20.17, so we're just going to say we are investing 20.17 million. 2015, we went a little bit down to 18.15 million, and then we start to increase again, so 18.9, 19.58, all the way till 2024 at 25.95. So that's good. That just means we are keeping investing more, so we can just profit more. Our financing is also a negative number, which just means that that is the money that we're most likely borrowing from the bank. So it's going to be a negative number. That's what it's supposed to be. It's a good thing that the numbers are lower, because we don't want to be borrowing all this money and have to pay back the bank. So we started out 2014 with negative 9.82, which is a good number, and we steadily decreased. So from negative 9 to negative 13, that is a pretty good jump, but it's gonna increase a little bit over time as you're spending more and trying to invest more, and you're gonna be taking more money out. So that's the only thing that I see as a little bit, not really problematic, but it's just kind of a high jump. From there, we steadily increase to 23.73 million by 2024. So we come down here to our ending cash balance. So what we're left with between operations, investments, and financing, and it's a positive number, which is very good. 2014, we have 9.18 million. We're increasing to 14.38 million in 2024, so that's really good. Let's see. concerning the projects that I picked, one thing that I really focused on was the, let's see. One thing I really focused on was the NPV. So let's see. Get to it. Okay, so the NPV is the net profit value. That's something that you really want to focus on, and if it's above 1, then it's really a good thing. The IRR is the internal rate of return, and that's just like how fast you're going to get the money, like the percentage that you expect to get the money back. We have the discount, our payback period, which is 9.21. That's just like how long it's going to take to get our payback period back, or to get our money back. Let's see. So here we have Match My Doll clothing line up here, and we have a 7% discount. So one thing that I did when choosing my projects was I tried to manipulate this number and go up a little bit or down a little bit to see if it would change the NPV, the IRR, for it to be more desirable. And you can also see if the risk is high and anything like that. And it'll also give you projections of all of these things, your NPV, IRR, payback period, and everything. Well, it may not give you projections of that, but all like the discounted cash flow and stuff like that. But for 2015, you have your numbers right there. It also gives you projections for your income statement. Again, we see here, and all that stuff. So some of the projects that I picked are here. In 2009, I picked the new doll film, in DVD, and it says the film was released on schedule. The marketing campaign was very successful, and DVD sales exceeded those of NH's previous films. So when we go to, let's go to new doll film. Okay, so the risk is medium. The NPV is 8.68, so quite a bit, so obviously above 1, so very good. The IRR is 238, so that is a tremendously large number, which is really good. The payback period is 1.43, so if that's in years, so just like a little bit over a year, which is not bad. Not really going to focus on PI that much, but the licensing, I think I manipulated this one to be 10%, so it would have more favorable NPV and IRR rates. So as you can see, we have a net income at 2015 for 2.32. And ending cash balance at 2014 of 0.4. So not that much profit right away, but still profiting. In 2010, I decided to do Match My Doll clothing line. It says it outperformed the expectations after a celebrity's daughter was photographed wearing items from the line shortly after its debut. The gross margin was higher than it was expected to, or expected to be, due to lower than anticipated raw material cost. So all good things. If we go back to that one, Match My Doll, we see that the discount rate, I made it stay at 7. The risk was high, but when reading, you have to like pay careful attention to everything that is said in the paragraphs and kind of all the numbers together as a whole to decide if it's really something that you think that would really profit your business. So the NPV 11, really good. IRR 23. Payback period is quite a bit more, but in the long run, it's worth it. So that's not too big of a deal. So our net income for this one in 2015 was 1.10, and we did end up with a cash balance of 0.32, and as you can see, it is increasing really well with that, so we are profiting. Okay. In 2011, I did Match My Doll clothing line, but the expansion of the concept, it said it benefited from the strong performance of the initial Match My Doll and has outperformed projections. So if we go back, look at that one. It was at 7.85, the NPV 9.68, decent number. The IRR 27. Payback 7.69, so not as many years. That one gave us a net income of 0.77 and a ending cash balance of 0.25, and our profits are also increasing. So that is good as well. In 2012, I did the virtual doll community. That one, the cost ended up being 3 times higher than budgeted, and revenues were lower. So not that great of an outcome, but it predicted that it's still going to be profitable. I also decided to do the bookstore cafe and writers club. So the revenue was higher than expected, but there was also lower growth margins. So it just kind of evened itself out. So if we go back and look at those, if we do, let's see. Yeah, okay. Okay, so we'll do the virtual doll community. So it is a higher risk. The discount rate was set at 7.85. The NPV was 5, which is lower than most that we've been seeing, but it's still a good number. The internal rate of return is 402, which is really really high, so that's good. So the net income is 0.76, so a decent number, and the ending cash balance was 0.13, so that's pretty low. And even though it's pretty low, it is still increasing, so we are still profiting from that. And then we had the bookstore cafe and writers club. NPV of 9.35, good. 51 IRR, payback period in only 4 years. The net income 0.49. And the ending cash balance 0.20, and we are steadily increasing all the way to 2023 as predicted. Alright, and the last thing that I decided to do in 2013 was select the Dollhouses with Miniature Dolls. It launched successfully, but had lower margins attributable to higher production and marketing costs. I also decided to do the coupon promotion and frequent shopper campaign, and it was effective but fell somewhat short of the retail division's revenue targets. So these projects weren't as successful as previous projects. So if we go ahead and look, So our dollhouses with miniature dolls, it is a high risk. It does tell you that. The NPV is pretty high. The IRR isn't bad. The payback period is a little bit higher with the 7 years. So there is that. So our net income, we got 0.48, increasing. Ending cash balance, it isn't a negative number, so there is that. But as you can see from operations, it does start out negative, which you're buying into it, so it's probably going to be negative anyway. Yeah, so ending cash balance 0.20, increasing. Not as bad as it could be. Alright, and the coupon. So this is a low risk. So not that bad. The NPV is 7. The IRR is 26. The payback period is 7.99. So also almost about 8 years. So that's pretty significant. We do have a net income of 0.11. And we do have an ending cash balance of 0.30. And it is very, very steadily increasing. So not being that profitable, but we aren't in the negative. So there is that. So after going through all these projects, reading everything about them, reading all the numbers, and looking at the projections for the income and the revenue, I ended up with, as I said earlier, an APV of 414.77, and my cash flow from 2014 to 2024 is predicted to just keep rising. So, yep, I think that's it.